This is the Asia Trade. I'm Shery in Tokyo.
And I'm Haidi Stroud-Watts in Sydney. These are the top stories this hour. Caution returns to the markets ahead of Friday's key US jobs reading that's set to shape the Fed's rate outlook. The ECB delivers a long-flagged 25 basis point cut, but stops short of indicating if more will follow. Plus, the US said to be opening antitrust investigations into Microsoft and Nvidia over their dominance in AI.
And Haidi, for months, the ECB had flagged that potentially we could see that cut of about 25 basis points has finally happened. And of course, they were on hold for about 9 months. And what we're watching right now is that they upgraded their inflation forecast, which is why the euro also gained ground against the US dollar. But at least we have the ECB out of the way. We have the BOC out of the way. Of course, we have another big one in Asia this week.
That's right, and of course so much focus has been on India with the electoral upending of expectations there, but we are also looking ahead to the Reserve Bank of India decision as well. They cannot really ignore the fact that we have had this deeply negative market reaction to Narendra Modi's upset at the polls, but Bloomberg Economics does not see the RBA responding with a rate cut this Friday. Investors are concerned about in the longer term in terms of that diminished position within that coalition deal that's been struck and what that means, of course, in terms of potentially jeopardising some of these pro-growth reforms. Shery.
It's a very difficult position for the Central Bank of India, right? I mean, they do have that negative market reaction from the election, but do they really want to risk capital outflows given that the Fed hasn't moved? We're watching that and that divergence really leading to trade across Asia. We have seen the dollar weaken a little bit against major currencies, which has sent the Japanese yen holding steady in the narrow trading range. And we're seeing right now Nikkei futures to the upside of 0.2%, perhaps extending those gains that we saw in the previous session. But of course, household spending will be the key one to watch in Japan in about half an hour, which will give us an indication of where the economy and that demand-driven cycle is headed. U.S. Sydney futures at the moment up 0.2%, and we're really not doing much with A50 China futures as the yuan holds that 725 level. But really, we have been watching, of course, that AI story with reports of that investigation into Microsoft and Nvidia as well. So if you flip the board, you can actually see that U.S. futures at the moment, although they're unchanged, we have seen that sideways trading for a little bit, especially given that we're headed towards that jobs numbers. Now, let's bring in our executive editor for Asia markets, Paul Dobson, because, Paul, we have seen the market consensus being really gains for jobs for the month, but at the same time, no change in the unemployment rate. But Bloomberg Economics now says that the unemployment rate might tick up. So what is the expectation right now?
Yeah, and the jobs market seems a little bit nebulous, and our Bloomberg Economics colleagues see some reasons to expect some pretty big revisions in the data through the year. But I guess for traders, we'll still have to concentrate on the data that we are getting and how reliable that is. Now, this past few days, we've seen evidence of slowdown in the labour market in the US. People are looking for an increase, but not a humongous number this time around. And, you know, steady as she goes on the wage growth figures as well. I think that it will be very important to see what sort of a number we get. You know, if it shows signs that the labour market is really deteriorating rapidly, that would be cause for some alarm, given the recent sort of run of slightly less positive economic data that we've had. On the other hand, if it shows that the jobs or the labour market is cooling but still looking reasonably strong, then the market is likely to take that as a pretty big positive. Yes, it will still put us on that glide path for the Federal Reserve to start cutting later in the year, but it won't ring any alarm bells about the economy. So that's kind of Goldilocks scenario is what the market is looking for and expecting, which is, you know, you could say optimistic, but it's what we've had for most of this year so far, and everything has gone pretty smoothly in that respect as well.
Well, when it comes to the ECB, obviously this was very well flagged, but it kind of goes to how fine the balance of risks are in that July is being ruled out, September is looking very unclear.
Yeah. Yeah, hi, Heidi. I think the ECB is interesting. It's getting a lot of criticism from the economists out there who's saying, why are you cutting at the same time as you're revising up your inflation forecast? Surely that, kind of if you're seeing inflation quickening again, then you don't want to be easing off on the gas. Christine Lagarde did give that kind of impression that the policymakers are confident that inflation will be slowing later on. But she also was a little bit direct in the way that she alluded to when a next cut could come, not until late in the summer, the end of the summer. And so that has the market not looking for anything again until September, and that far from nailed on as well. Only pricing in for one more cut this year. So we saw a slightly counterintuitive increase in bond yields and increase in the euros, as Shery was saying at the top of the show, as a result of that.
Our executive editor for Asia Markets, Paul Dobson there. Let's get some more insights with Ron Temple, who's a chief market strategist at Lazard. So, of course, it is such an interesting time in monetary policy in this cycle that we find ourselves in. When it comes to the Fed and looking ahead to these jobs numbers, the messaging has been pretty consistent so far, right? What do you make of the levels of market repricing that we're seeing?
Yeah, I think we're going to have some really important news over the next week that'll help steer the markets in the right direction. Obviously, tomorrow we've got the jobs number that you've just discussed, and next week we get the May CPI report for the U.S. I think the market, if you really step back and look at it, has had some pretty wild mood swings. If you think back to October last year, the market was saying the Fed would basically cut rates 50 basis points by the end of 2024. By the middle of January, the market was expecting 165 plus basis points at easing. And we recently got to as low as 30, 35 basis points. So some pretty big volatility there in terms of expectations. But I'm still confident we're going to see inflation subsiding as we move it through the year. And I think next week's CPI report will be very important to give us a sense of whether we're heading toward that milestone.
In the meantime, how do you feel in terms of portfolio allocation, right? We've had this at, 25 now record highs when it comes to the S&P 500. Do you think that overpricing for US stocks is something that perhaps makes international more appealing?
Yeah, I do think non-U.S. markets are becoming increasingly attractive relative to the U.S., in part because of the valuation divide. But it's also because if I look outside the U.S., there's a lot more room for economic growth to accelerate while the U.S. is decelerating. I think that should lead to stronger earnings growth in non-U.S. markets, while the U.S. geography of earnings will shift. What we've seen over the last 2.5 years is almost all of the growth in S&P 500 earnings, or a sizable majority of the growth, has been really narrowly based around a handful or two handfuls of stocks focused on technology and AI. And I do think what you're going to see is over the next couple of years, a deceleration of earnings growth for those tech AI superpowers. And you're going to see hopefully broadening growth in the rest of the U.S. market. So it's not a bearish outlook for the U.S., but I think there's more basis for optimism outside the U.S. because those markets really have lagged for quite some time. And again, have more recovery potential and much lower valuations. So again, I'm pretty optimistic on equities globally, but I think the opportunities in emerging markets in Japan, for example, might be better than in the U.S.
Yeah, I'm now here in Tokyo, and I keep hearing about the optimism for the stock markets here in Japan. But at the same time, given that we've already seen a rally, I wonder how sustained can it be? And are you seeing really fundamental changes when it comes to corporate governance as well?
Yeah, I think the moves over the last 2 years in particular, if you think back, really, the corporate governance code was implemented, nearly a decade ago during the Abe administration. But over the last 2 years, the Tokyo Stock Exchange has really taken the baton and run with it in terms of introducing more requirements for prime listed companies. And we've seen quite good compliance over time from companies announcing capital action plans to improve their returns on equity and effectively raise their price to book ratios of their stocks. Now, I think there are more legs to this story. I think the fundamentals of the Japanese economy, of inflation and wage growth, have improved materially. Clearly, the early indications from the Shunto wage negotiations have been better than anyone expected over the last few months. And I think that will translate to domestically driven inflation. But the other piece of the story that gets me quite energized is watching household financial assets and asset allocation. And even over the last couple of days, we've gotten new data on year-to-date inflows into NISA accounts, the Nippon Individual Savings Accounts, up over 300% year on year, largely on the back of government policy changes implemented in January. But what's important to me there is we're seeing a much bigger allocation within those NISA flows to domestic equities and mutual funds. So it does seem that there is a new group of investors in Japan allocating capital into Japanese equities at a pace that actually exceeds the most rapid pace that the BOJ had over the last 5 years. So again, quite encouraging signs that we might be seeing domestic appetite for equities in Japan that could lead us for another leg of upside.
And there's also been a lot of optimism over more automation here in Japan. How do you play that technology theme, not only in Japan, but across Asia, I guess, because we're now hearing that SK and TSMC have agreed to strengthen cooperation in AI chips as well.
Yeah, I think it's really interesting. If you think about the story around AI so far, a lot of the enthusiasm in the equity market has been around the companies that you might say are building the rails that the AI economy will operate on. And so, there have been basically, let's say 10, 15 stocks globally that have had some pretty tremendous moves. And I would argue those are warranted in many cases because I believe artificial intelligence will be one of the two biggest economic disruptions of our lifetime alongside climate change. To me, the next exciting step of this is identifying the companies globally. And there will be quite a few in Asia, quite a few in Europe and the US, who will figure out how to capitalize on the AI opportunity. And these might be companies who have long histories in areas like robotics and automation. And I emphasize robotics because historically, you think of robotics, you think of assembly lines, right? You think of manufacturing. AI in many ways is about automating the service sector. And so it might not be exactly the same companies, but you might find some of the same players who've had a long history of figuring out how to improve efficiency and automate processes, and will translate that into expertise in the service sector alongside the more industrial side. So I think there are going to be many ways to play it. And I think that's the exciting opportunity. And then maybe the third iteration of this story will be, okay, which customers of the second group of companies can really capitalize on this to gain a competitive advantage in an entire array of industries from healthcare to financial services to consumer.
Where does China stand in this narrative, especially when it comes to their tech sector?
In theory, had you asked me that, say, 5 years ago, I would have said China should be in the lead because, again, if you think about AI, a lot of the firepower you gain in AI is from data. And obviously in Western countries like the US and Europe, you also often have pretty strict data privacy rules or other protections for consumers that you might not find in China. And I believe even the book several years ago, AI Superpowers, was in part premised on the idea that China would have an advantage based on data. But when I look at it now, it does seem that the U.S. companies have really taken a lead on AI in terms of putting commercial products into the market and allowing people to actually capitalize on this opportunity. So I would not discount China, but I do think there also could be some impediments to China's rise from the actions from the U.S. with allies in Europe to try to curtail the availability of certain high-tech equipment. So we'll see how it plays out. I think China is definitely still a competitor, but right now I would give the lead to the U.S. companies on this front.
Ron, do you think earnings expectations will hold up if Trump manages to succeed in November? How do you, or are you looking at the risks around that scenario?
Yeah, well, the first point I would make is I think it's too early to call who's going to win this election in the U.S. I mean, this is going to be, I think, a razor's edge story all the way up to after November 5th, potentially, as we count votes and dispute outcomes. But I think to the point of your question, markets are not yet focused on what Trump's policy proposals could mean to growth and profitability. And I think once we get toward the latter part of August into September, investors will be forced to start thinking about this more when they know who the vice presidential nominee is on the Republican ticket. That will help give some context. But I think what's really important is when you really step back and consider Trump's proposals on tariffs, the idea of a 10% tariff on all imports into the United States, a 60% tariff on all imports from China, to the extent those policies were actually implemented, that could be very disruptive, A, to supply chains, B, it could step up inflation in the U.S. exactly the time when the Fed's considering whether they should be cutting rates or not. But C, I think the least discussed topic is what it does to corporate profit margins. If you imagine if you're basically a large importer of products from China, where only a small part of the value add might be Chinese, it might be assembling tech components from Korea and Taiwan, then ultimately assembling them in China and shipping them to the US. If you put a 60% tariff on those products, that could be a big hit to profit margins across a range of industries, especially products that are discretionary in nature, where consumers don't have to buy them if the price goes up materially. So I think this is something people should be thinking about more. And again, it crosses a wide array of sectors on that cost of goods sold impact. And it also, by the way, almost invariably is going to mean retaliation, especially from China and other countries, and that could disrupt sales of American products.
Yeah, we're going to be watching all of those risks, especially given that the political election season is now underway and we're headed towards the presidential elections. Wrtn Temple, Chief Market Strategist at Lazard, thank you. And coming up on the Asia Trade here, why Carlyle's Kazuhiro Yamada thinks Japan is entering a golden era for private equity, while Goldman Sachs believes a strong for longer dollar is a headwind for Asian equities. Plus, catch our exclusive with South Korean artificial intelligence startup Wrtn Technologies. More ahead on the Asia Trade. This is Bloomberg.
Alibaba.com says the company wants to use AI to improve global trade. Their president, Zhang, told us exclusively about those plans for the technology.
Actually, this year we are targeting on two parts. The first part is about AI. So, AI GC, the generative AI, actually is one of the biggest kind of breakthrough for the technology. And using AI in global trade actually is one of the perfect user scenarios. So many use cases that we can help to improve the efficiency for the sellers. We can help their efficiency, how to post product, do the marketing, do communication with buyers, and as well as to manage their business, to see data. And we are using the technology to help the seller, the buyers as well. So previously the buyers using Alibaba.com as a sourcing engine. And now with help of AI, this kind of a creativity engine for the buyers. We can help them to generate a product which can fit their imagination. And we can use the agent to help them to source, to connect and trade with the right partners. So all this kind of technology can lower the barrier for the seller and the buyers.
Where else are you looking for expansion? Then we spoke about the Visible acquisition. Are there any other companies that are in your sight at this point in time? So
two types of companies that we have interest. The first one is about the technology. So, for example, we make investment in Vantage and in Oki. One is to help us to build up the kind of a trade network. I mean the payment, the fintech part and the logistic part and the custom clearance part. And Oki actually is the work part, work at Alibaba, which provided all the SaaS kind of services for the customer, just like a CRM, like what a Salesforce to do for the salesman. Actually, we provide a similar CRM system for the traders, for the sellers. And we buy this for the technical pillar. And the other pillar is the marketplace, like Visible. So there are more supplies and demand, and we can help them to upgrade their technical engine. So for this part, we can help the marketplace to be a better marketplace. So these two type of pillars are the companies that we have interest in. And we are kind of working with different partners around the world, not only by acquisition, but also by all type of kind of partnership.
And you've obviously made these acquisitions and developed this strategy at a time when Alibaba itself has been going through organizational change, because we've seen a new leadership team coming in and we've seen plans that had been discussed around splitting off different business units, listing those. That has also been changed as well. So what's it been like operating in that sort of environment, and do you think that there's more clarity now moving forward?
So Alibaba.com is a part of AIDC, is Alibaba International Business, and we are the B2B part, and they are the B2C part as well, like AliExpress, like Trendyol, Lazard. So one thing that we can feel is that the collaboration is more close with each other, since we are in the same kind of territory, which is global trade. either it's a regional or cross-border. There's a lot of technologies, a lot of kind of infrastructures we can share with each other. The second part is about the decision-making. The decision-making is more straightforward and much faster, and this is very important for the business. And the third part, I think, internally, everybody feel inspired by the entrepreneurship. So there are more ownership, you make more decisions by yourself, and the business can go faster. I think this changed the mindset and the behavior of the employees daily basis. And what do we say that is change is only constant thing in Alibaba, I think in many of the tech companies as well. So what do we want? We do today is leverage the best of that.
Alibaba.com President Zhang speaking exclusively to Bloomberg tech reporter Annabelle Jewelers. Let's actually talk about big tech in the U.S. as well. Regulators are said to be investigating two major companies, Microsoft and Nvidia. Sources say the focus is on their dominance in the AI space. Our tech reporter Bell is in Hong Kong. So we've known that the U.S. DOJ and the FTC have been concerned for quite some time.
Yeah, that's right, Shery. You've got the Justice Department, the Federal Trade Commission, and we know that both of these agencies have been really looking very closely at AI for a period now, and actually we understand from sources they were at least for about 6 months trying to figure out which agency would look after which company or regulate each company. But the decision's been made, and so the FTC is going to look after Microsoft, and then the DOJ is going to be looking into Nvidia and its dominance in the AI chip space. But what both of these agencies, the FTC and the DOJ, they're really united here in that concern that these companies could dominate AI in a way that we saw just a handful of companies really taking control in the early days of the internet and the mobile space as well. But the FTC in particular, they're quite concerned around some deals that Microsoft has done that perhaps didn't follow a traditional deal structure.
What exactly is being investigated?
Yeah, well, the FTC, as I mentioned, looking into Microsoft, there's a couple of different concerns here. Firstly, there's its partnership with OpenAI, and Microsoft's poured more than $13 billion into that partnership to date. And then there's another deal that was done back in March of this year where Microsoft paid a startup, Inflection AI, about $650 million to license its software, and also it hired a lot of its staff from that. And what's really intriguing about this, and has certainly caught the attention of the FTC, is that those deals were structured in a way where Microsoft didn't actually need to notify regulators ahead of time. In a typical deal structure, they would need to notify and then they would need to wait, but in this case they didn't. So now antitrust officials are looking at this, plus how Nvidia has really dominated the market of AI chips. But important to note as well, if they do anything, it really could be months, even years down the track.
Annabelle Jewelers there in Hong Kong. More to come on the Asia trade. This is Bloomberg.
Take a look at how currencies are trading at the moment. Super peso taking a big hit in the overnight session. This after the leader of the ruling party in the lower house said the lawmakers would seek to pass a series of reforms that could remove checks on the government's power. Remember, we had the prospect of that overhaul for the country's institutions before President-elect Claudia Sheinbaum takes office in October. We're also watching the euro, of course, after the ECB decision that upgrade in inflation forecasts pushed it higher. This is Bloomberg.
This is the Asia trade. We're about 30 minutes away from the major market opens. Here are the top stories that you should know. The ECB has delivered on its promise to cut interest rates with a quarter-point reduction, but it's also left investors guessing on where policy is headed next. Officials say it will take longer for inflation to reach 2% and revised its CPI forecast for next year higher.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction.
Focus now turns to the US jobs report due out later on Friday. Bloomberg Economics expects May's data to present contradictory views of the labour markets, with non-farm payrolls as well as unemployment rising together. And the US is said to be opening antitrust investigations into two of the world's most valuable companies, Microsoft and Nvidia, over their dominance over the rapidly emerging field of AI. Sources say the FTC and the Justice Department have agreed to divide responsibility over those investigations. Shery.
Right, take a look at how broader markets are trading at the moment. We are setting up for the open with Sydney futures pointing to the upside of 0.25%. And of course, Nikkei futures down 0.3% after we saw those gains in the previous session. We're getting household spending numbers and growth year on year of 0.5% for the month of April. That is in line with estimates and really rebounding from 13 months in contraction territory year on year. Of course, we have seen that inflation acceleration in Japan, pushing households to cut spending. But this week, we did manage to see the biggest wage hike since 1994. So we'll continue to watch whether pay increases do actually keep up with rising costs of living. At the moment, we're seeing on a month-on-month basis still contraction, but year-on-year is growth of 0.5% as expected. Well, let's stay in Japan because our next guest thinks that we're now entering the golden era for private equity in Japan. Joining us in the studio is Kazuhiro Yamada, co-head and managing director at Carlyle, Japan. Kazu, great to have you with us in the Tokyo studio.
Thank you very much. Thank you for having me.
You've been here in Japan for a very long time, but at the same time, we're seeing a very gloomy environment when it comes to globally for private equity investment. So what makes Japan different?
Yes, there's significant, investment, attractive investment opportunity here in Japan, and basically three areas. One is the, lots of succession issues. Based on our data, about 1.5 million number of family-owned company has no successor, so neither so-called any solution. So it's a great opportunity for investment in those succession opportunity. The second is corporate carve-out. That situation exists almost 20 years ago, but now Japanese CEO take action thanks to corporate governance code enhancement and the strategic code. That's kind of accelerate more spin-off opportunity. Third is as you know 2 years ago Tokyo Stock Exchange made a reform and push Japanese CEO to increasing profitability, and the most significant one is PBR, one PBR. That's the policy. So that is also accelerate also delisted transaction. Japan is the only country increasing number of listed company in the last 10 years.
It's very interesting that you're actually targeting the changing demographics of Japan with succession issues, those types of companies. Tell us a little bit about how the mindset across Japan has changed, especially when looking at PE investments.
Yes, I think we in the last 25 years we think significant opportunity exists, but nothing happened. Because of one is the PE recognition is kind of low compared with the other Western countries, but it's good general change, and thanks to lots of so-called historical track record and successful track record. Second is again corporate governance, and thanks to that corporate governance, Japan's CEO mindset is a totally change. So now, more focus on, demonstrate growth, increasing profitability, then, focus on core business, spin-off and non-core. That is a new trend. It's a common sense for Western CEOs, but a new for Japanese CEOs.
There's a lot of new funds coming in as well, right? How do you assess the competition, the competitive landscape when it comes to PE in Japan?
Yeah, it has been increasing because of, everybody's eye on Japan. And so there's some newcomers, and also even if existing players would like to enhance, so-called, resources. But one of the challenges, there are, very few, talent, PE talent here in Japan. They also, even if they have a, liquidity or dry capital, dry powder, but without any good track record, trust, reputation here in Japan, it's difficult to identify or investment opportunity.
What are the preferred sectors that you're identifying the most opportunities, and also the preferred, I guess, structure and types of deals?
Yeah, we have a 3 industry team: consumer, retail, healthcare, and TMT, and also general industry. Each industry has each investment strategy, but basically Japan is a manufacturing country, so there's a good company manufacture good products, but not enough resources to increasing particularly sales or revenue in globe. So that is the very attractive. Healthcare is a growing sector, and also TMT software. SaaS business is very attractive. Since one of the big problems for Japanese company is a low productivity in a white collar. So there's significant so-called growth opportunity here in Japan.
Kazuhiro, you've talked a little bit about the sort of supportive government measures and policies that we've seen. I do wonder what other reforms and initiatives do you think would further create more excitement and opportunities in this space?
Yes, so Japan, government is very, supportive to, private equity, activity. So, in addition to, corporate governance and stewardship code, they also, implement some, kind of, tax benefit, transaction delisted or Tokyo Stock Exchange reform as well. So, I think, generally, now, private equity is going to be, maybe, more important, vehicle or important function of, so-called, economic, recovery or economic growth.
Given, as you mentioned, the government efforts, not to mention the more understanding within Japan for PE, does that also mean that the landscape is becoming more competitive?
Yes, I think, that recognition is totally changed compared with the last 20 years. So I think actually when I started PE career here in Japan, I think it's the most challenging is do the business with the founding family because of they are very far from us. But since there's a good track record in succession deals, they are more aggressive than Japanese corporates. That's quite different. So always global investors say Japan is similar as a Western German. Oh. So very German is also in a similar situation. A little bit hesitation of acceptance of a PE concept, but Japan now is a totally different. So I think in the next 10 years is going to be a very golden era for private equity.
Yeah, and before we let you go, I wonder if that KFC Holdings Japan initiative to take it private falls into that strategy, and what can you tell us about those plans? Yeah,
since it's TOB, so we cannot tell any detail. But Kentucky has great reputation, great franchise here in Japan, and great track record. And actually, number of shops in China is larger than McDonald's. This is one of so-called maybe a potential area to grow, and also maybe digitalization, application order for application is another area to improve.
Kaz, it was really great to have you in the Tokyo studio. He is Kazuhiro Yamada, co-head and managing director at Carlyle, Japan. Let's turn to alternative asset manager KKR as well. That's seeing private markets continuing to outperform amid a structural shift in the industry. The company's global co-head of private equity, Peter Stavros, spoke to us on the sidelines of the Super Return International Conference in Berlin.
So companies are staying private longer and, are not accessing the IPO markets as much as they once did. And so you're seeing this institutionalization of private markets. And that has certainly benefited private equity. And I think it's also benefited the performance of private markets relative to the public markets. If you look at the Russell 2000 and you compare that relative to the buyout universe in terms of growth and margins and return on capital, the private markets today have a stronger portfolio. And then on top of that, private market investors can pick their assets, choose their management teams, pick their entry and exit points, customize their capital structures, design really sophisticated incentive plans, and drive value creation. So I think for both of those reasons, the public markets, I think, are set to continue to, the private markets are set to continue to outperform.
I wonder what to degree this is a healthy trend. Because if you think of everyday retail investors, their access into the market, it's through an ETF. It's maybe they log onto their Schwab account and choose individual funds. What does it mean for the world if they have less of an option, if more of the companies that they can access are just such a small percentage of the universe?
Yeah, well, I think we're going to have to find ways for retail investors to participate in the private markets as this shift, continues and as the private markets continue to gain share. And today, the way it works is, for the most part, if you have a pension fund, your pension fund might get good access to alternatives. But short of that, historically, you've been out of luck. And there's a number of managers, including us, who are working on the so-called democratization of alternatives.
So in this world of maybe more muted returns, I know one way that you're trying to squeeze out performance is by looking at the corporate culture. I know you're giving equity to some of your companies, some of the workers in those companies. You're looking at CEO empathy as a measure. Pete, this is very different. You're almost Pete the psychologist just as much as you are Pete the investor. What was the change in mindset for you? What prompted you to start looking at this as a factor of company attractiveness?
Oh, gosh. Well, part of it is how I grew up. My dad was a construction worker, was a member of a union, and he hated his company. And there was, we lived through a lot of strikes as a family growing up, and that left a mark for sure. And you could also see not only it being bad for my dad and his colleagues, but it's bad for the company. I mean, at every turn, if my dad had a chance, he stuck it to the company, believe me. And that is corporate America. 70% of Americans are disengaged on the job. An average company has between 15 and 20% of its employees that Gallup defines as actively disengaged, meaning they are literally throwing wrenches in the machines trying to hurt their employer.
It was KKR's Peter Stavros there speaking at the sidelines of the Super Return International Conference in Berlin. More ahead on the Asia trade. This is Bloomberg.
This is the Asia trade. The top tech stories we're watching. Meituan reported revenue for the first quarter that beat the average analyst estimate. It's also preparing for a potential entry into the Middle East in its first expansion beyond the China region. Founder Wang Xing says they're beginning to consider the feasibility of other markets from Europe to Southeast Asia. Now, shares in Chinese EV maker NIO fell on a bigger than expected loss in the first quarter amid fierce competition in its home market. Its adjusted net loss widened to $677 million in the period. NIO's expansion in more profitable overseas markets is also facing headwinds with tariff hikes in the U.S. and another expected from the European Union.
Well, Shery, we are just a few minutes away from the market open in Australia. Banking shares are in focus. Investors ignoring warnings over stretched valuations that are pushing them close to multi-year highs. Let's bring in our Australian stocks reporter, Georgina McKay. So what's really been the big driver when it comes to these bank names?
Yeah, so we've had some amazing rallies in banks over the past few months, and this week even in particular, with Commonwealth Bank trading at a record almost day on day. So the recent May earnings showed banks performing a bit better than analyst expectations. Net interest margins, a key measure of profitability, look to be stabilising. Competition in the Australian mortgage market is easing. And then we've got banks that handed out about 5 billion Australian dollars of buybacks during that time. So lenders are signalling they don't need that cautionary capital. And then there was generous dividends, which is another positive sign. And then this week we've had home loans data that showed credit demand is remaining strong, momentum strong. So these positives for banks within their fundamentals that investors have sort of questioned behind these crazy high valuations are sort of coming through and improving a bit as the year goes on. And if investors want exposure to Australia, they're going to have to buy banks. So you've got flows coming in because banks are such a large part of the benchmark, and that's pushing prices and valuations just higher and higher.
What about the next catalyst? What can we expect that to be for the banking sector?
So Australia is the same as everywhere else, really, with rates and the inflation trajectory being the big focus for investors. Australia is now expected to be a bit of a laggard in cutting rates. Swaps are pricing even a 1 in 5 chance of a hike in the August meeting. And then rate cuts aren't expected to come through until later in 2025 now. That delay in rates, in theory, could be good for banks on the one hand, as they typically benefit from that higher rate environment. But then the higher for longer rates could see an already deteriorating economic climate possibly get worse, with consumer spending slowing, growth slowing, and then asset prices declining and job losses coming through in the economy. So whether the rates being higher for longer is going to be good or bad for banks, it depends who you ask. It could be quite mixed, but I think the health of the economy might be the prominent factor for that.
Georgina McKay, our Australia stocks reporter there, with what to expect in the banking sector. Now, the top geopolitical stories that we're tracking right now, Indian Prime Minister Narendra Modi says he looks forward to closer ties with Taiwan. Modi responded directly to Taiwanese President Lai Ching-te on social media. Lai had touted the fast-growing India-Taiwan partnership as he congratulated Modi on his third straight election victory. This comes as Modi faces the renewed challenge of managing India's tense relationship with China. Israel is escalating its warnings against Hezbollah in Lebanon, threatening it could be forced into a war with the Iran-backed group. Prime Minister Benjamin Netanyahu now saying that he visited a northern town in Israel where Hezbollah's rockets have caused significant damage. He vowed to restore security in the area one way or another. The U.S. said this week it's pursuing a peaceful solution between Lebanon and Israel to prevent a full-scale conflict. Haidi.
And this, of course, one of the elements that oil traders are watching, with geopolitical risk still front and centre. As we head into Friday trading, oil is set for that weekly loss, mostly, though, on the supply plan from OPEC Plus, continuing to rattle market expectations as they see to potentially return some supply this year back to the market. We're on track for that weekly loss. Some members of the alliance being prompted to reassure the market more broadly that the group is still committed to stability. We are seeing that two-day gain when it comes to New York crude, but we are still looking like weakness on a weekly basis. We saw Brent closing below $80 a barrel. OPEC Plus minister saying that the group can still be reactive to any changes in the market and adjust supply as needed. But of course, we have seen that lower trend for crude prices since about early April, largely on the weakness in the demand outlook. Of course, we know that China's property woes continue to play out as well. There's some concern over a slowdown in global demand, given the uncertainty over where monetary policy sits. And of course, so much of this coming back to what we saw from the ECB, the uncertainty in the path to come, and watching those jobs numbers from the US now. More ahead on the Asia trade. This is Bloomberg. Some corporate stories that we're tracking this hour. Boeing's space taxi has docked with the International Space Station, bringing the two spacecraft's first two passengers, I should say, to the orbiting laboratory. The docking process had been delayed earlier due to a thruster malfunction. The docking was a key moment for this long-delayed Starliner spacecraft and an important test for Boeing. And SpaceX's Starship rocket blasted into space before plunging back into Earth's atmosphere for an ocean landing, notching a key objective on its fourth major test flight. The vehicle landed in the Indian Ocean mostly intact. Elon Musk plans to use Starship to launch larger Starlink satellites and eventually bring cargo and people into space. And Shery, we've really got to talk about this big move. This is one of the stories that we've really been following over the past years now. This is, of course, talking about GameStop and the big moves that we saw, the volatility, the shares just extending those gains now still post-market, 47, just about 48% there higher in the US session, and really triggering multiple volatility halts there as well. We've really seen this kind of drama playing out when it comes to Keith Gill's Roaring Q Kitty, the fact that we've seen just so much interest is still adding to his haul from positions that he disclosed on his Reddit account at the start of June. So that's 120,000 calls at $20 expiring on June 21st. We're now seeing that worth some $325 million. That's an unrealized profit of about $260 million, according to these numbers that we've been crunching at Bloomberg. Shery.
Those holdings unverified, of course, but that 5 billion GameStop shares that he paid roughly $106 million for are now supposedly worth almost $120 million more than that. So really, the power of retail investors again at play. But take a look at how futures are setting up for the Asia session right now. Of course, we had seen some gains for the Nikkei. And right now, futures looking like this after the Japanese yen sort of steadied in narrow trading, given the dollar is still under pressure ahead of Friday's U.S. employment report. So we're seeing U.S. futures at the moment unchanged as well. But we've been following here in Japan those reserve numbers when it comes to the Japanese government and how much they've intervened, given that we saw those numbers of $63 billion of potential FX interventions. And now we're hearing that the official reserves are standing at $1.23 trillion in May, which is really a contraction from $1.28 trillion in April. Haidi.
We are now also seeing, when it comes to BOJ expectations, Shery, of course, this is starting to shift as well. A lot of this will come down to what the Fed will do, but more than half of the surveyed Bank of Japan watchers are forecasting that the BOJ will decide to trim government bond buying when authorities meet next week. A growing number is also actually looking ahead to a rate hike in July. So 70% seeing the possibility of the move on the bond markets really rising due to the weakness that we've seen recently again in the yen. So the poll showing that a lot of analysts are moving their timeframes forward for that move from the Bank of Japan when it comes to its rate settings. The market opens in Sydney, Seoul and Tokyo are next. This is the Asia Trade. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Haidi, we have the ECB out of the way. The much-awaited rate cut has already happened. We're looking forward to the RBI, not to mention, of course, U.S. jobs numbers as well.
Yeah, and interesting with the ECB, of course, July is very much kind of being ruled out now. There's a lot of uncertainty over September, and that just goes to how much uncertainty there is for global central banks, right? And you're right, the jobs numbers from the US overnight is going to be really key in terms of perhaps firming up over the next week or so these Fed expectations.
Yeah, where the Fed goes from here, really a big driver where currency markets are going as well. The dollar's a little bit under pressure in recent trading, but that's really got the Japanese yen holding at that narrow trading range. And for the first time, we got data here in Japan that households have boosted spending for the first time in 14 months. So perhaps a little bit more economic optimism on the rise across the country. But you're seeing the Nikkei now reversing some of those gains that we saw in the previous session, down 0.25%, while the Japanese yen is still holding at that 155 level. We're watching JGB yields very closely because we had the solid 30-year auction that sent JGBs rallying in the previous session. And of course, South Korea also coming back from holidays. And we've been talking so much about these tech giants globally. We're also hearing from SK Hynix that they're actually partnering up with TSMC when it comes to the production of AI chips. So if you switch the board, you can actually see that the Kospi is coming online, gaining about 1%. Before they went away on holiday, we had already Samsung also gaining ground because of their partnership with Nvidia as well. The Korean won holding at that 1367 level, Haidi.
Taking a look at how we're setting up when it comes to Australia, banking stocks are in focus. We have seen this big rally to pretty close to multi-year highs for a lot of the bank names on the back of expectations from the RBA. But we are just coming online in the first few sort of minutes or so of trading, upside of about 0.1% there. We have seen bonds also here in Australia gaining after we saw quite a bit of easing from both the central banks in Canada, now the ECB, and now, of course, setting up for expectations from the Fed and those jobs numbers The Aussie dollar actually holding pretty steady. 66.68 is where we're at after a bit of softness over the past two sessions. And watching US Treasuries as well. Of course, we've been talking about these non-farm payrolls, potentially Bloomberg Intelligence suggesting that the FOMC will start to telegraph 2 rate cuts this year beginning in September. But, of course, we're watching to see what happens with this US data. Treasury is looking pretty much idle at this point.
Let's bring in our next guest who expects rates and the dollar to remain higher for longer. With us now is Tim Moe, co-head of Asia Macros Research and chief APAC equity strategist at Goldman Sachs. Tim, always great to talk to you and really good to catch up again. But we have been really watching what the U.S. is doing at the moment. Of course, that's going to really change the dynamics for what happens across Asia, especially if you see a stronger dollar. How detrimental could that be to Asian equity markets?
Well, Shery, I think you put your finger on the pulse there in terms of one of the key risks that we're looking at, particularly as we go into the second half for Asian equity markets. And that's that a strong dollar typically is challenging for Asian equity market performance, but especially over the near term, say the 1 or 2 months. There's some statistical evidence that the dollar actually contributes to the weakness in Asian markets, in a stronger dollar, weaker Asian markets, really through the intermediating factor of portfolio flows. So I think it's right to be focused on that. And of course, the reason for a strong dollar is that the Fed continues to remain on hold at a high rate. We've seen some of the other majors cut, including the ECB overnight. We think that the Bank of Korea may be one of the earlier ones in Asia to do so. So as long as you've got a wide spread in terms of funding costs between the U.S. and other counterparties, that suggests the dollar may remain strong. And I think that is one of the key issues that investors need to be monitoring, especially for Japan into the second half.
Yeah, especially if the dollar, though, remains strong because of more positive economic dynamics across the U.S. That could potentially be beneficial for some sectors across Asia as well, right? What are you expecting to benefit from U.S. growth?
So it's a great question. And we've done a fair amount of work in terms of the macro drivers for different markets. And I think, as you indicated, that it's important for investors to consider all the different dynamics, not just one bilateral set. So a lot of people focus just purely on the dollar cross rate, and my focus is on interest rates. But of course, you've got to put the whole picture together. And we've done that in terms of the ranking of relative sensitivities of different markets and sectors to all the different macro shifts that are taking place, whether it's rates, whether it's dollar, whether it's commodities, growth, geopolitical risk, et cetera. So the punchline here is that if we have an environment where you've got stronger for or better for longer growth, and higher for longer rates and dollar, which is sort of the near-term expectation. We'll see what happens as we get deeper in the second half. Then the parts of the region which are most favorably exposed to that would include places like Korea, Taiwan, and tech, quite clearly, because they're more growth and cyclically sensitive. And certainly parts of the tech spectrum, which are the so-called long duration, the non-profitable tech, but the profitable tech part is shorter duration and therefore has less interest rate sensitivity. So that would really be the areas of the market that would be most sensitive to the economic environment that you're describing.
Tim, you mentioned geopolitics, and I do wonder if that starts to add more volatility going into November, if there is perhaps a change of government in the US, how would that potentially play out for a scenario for earnings expectations in the US? And does that then also make perhaps international a more attractive way to hedge some of that risk?
So there's a lot of aspects to your question, Heidi, and let me try to unpack that if I can. So I think it's reasonable to expect or to think, to posit that there could be an increase in geopolitical risk, specifically U.S.-China tension as we go into the U.S. election, for the obvious reason that China is basically viewed on both sides of the political spectrum as a challenge. And so it's likely that political rhetoric could potentially increase. It's unlikely anyone's going to be talking a more dovish attitude towards China going into the election. We have a metric that measures U.S.-China tension, how that's priced into the equity markets. Right now, it's about mid-range, a little bit above mid-range, which suggests the market is pricing some, but not a huge amount of geopolitical risk. So if that risk does indeed rise, that could be priced in the markets, which would mean that markets can be somewhat more sensitive to the downside on that. So exactly the modality through which that occurs is obviously difficult to assess, and there's a lot of other chain reactions which you spoke to in terms of potential increase in tariffs and how that might affect, say, imported inflation to the U.S. and earnings and so forth. So there's a whole series of cascades which could take place, which is, I think, pretty difficult to say definitively what would happen prior to that. But I think what we can say with a greater degree of certainty is that there would be likely different outcomes in U.S. Assets, either S&P, the dollar, or long bond yield, depending upon which of 4 core scenarios occur in the U.S. election. Our global markets economists just wrote on that recently. So given that the race is currently tight, there's likely to be an increase in uncertainty about those outcomes as we go into the election, and markets might price some of that uncertainty along with potential some increase in geopolitical risk, as you mentioned. So, I mean, we're constructive on Asian markets. I want to be very clear about that. But if we think about risks going into the second half, I think the 3 that we've talked about in this conversation so far, which would be stronger dollar, that geopolitical uncertainty you mentioned, and also uncertainty or potential increase in volatility around the election. I think those are 3 things investors need to look at as we go deeper into the third quarter and we approach the election.
And certainly it feels like, tech and AI universe bifurcation will continue regardless of what that outcome might be, right? But how do you continue to invest into the next leg of that AI rally? Obviously, we've had big numbers continuing to come out from Nvidia, but do you look to the next few stages and how those beneficiaries around East Asia are going to play out?
Yes, indeed, we do. We've just written about that. So there's a couple of points to make here. One is that we've got a way of monitoring the AI theme in Asia. We have an AI GC basket that we have, which is 3 subcomponents, which are hardware, semiconductors, and applications. And then we can also segment that into the markets, which have AI exposure. Taiwan, which has about 70% of the market cap, having some revenue exposure to AI. Korea, about 40-45%, and then China, somewhat less, maybe about 30%. So when you look at that, we can see very clearly that Taiwan has outperformed this year, and also the hardware and semiconductor parts have outperformed. Markets not yet pricing sort of the down the road applications part of things. So that's actually run very well. Korea has lagged some of that this year so far, and I think a lot of this is attributable to the outperformance of TSMC versus Samsung. We just looked at this yesterday, and it's the outperformance there this year is 50%, whereas in the previous 2 years they traded pretty much pari passu. So there could be some potential for catch up in Korea along that theme. But then the other point, an important point to note, is that the AI trade is broadening out. It's not just the components of AI, but also some of the related aspects, most notably energy use. So one of the top performing sectors, in fact, the top performing sector in Asia year to date, is the utility sector. And who would think that that sort of defensive and out of favor sector would become the top performing sector after tech? And the answer, of course, is that there's an AI angle to it because data centers are very energy hungry and utilities are providing that. So we like the power theme as well. So I think those are different ways to play it and ways to think about how the trade unfolds over the next coming months.
Tim, when it comes to Korea, that value up program by the government seems to have disappointed many investors because of the lack of details there. What do you make of it?
In a word, we think the market's being overly negative or skeptical compared to what's actually happened, what's on the table. So we totally understand that the market would like greater clarity and specificity and perhaps more teeth to regulatory enforcement, as your question implied. But to argue that it's of no value at all and has not had, and there's no positive progress, I think is ungenerous. And we say that for 2 reasons. One, the value program was announced in February. Already there's been a series of events which have provided greater specificity, and there's a roadmap for doing more. I won't go into the details in the interest of time. But when you go from nothing to something, there should at least be some recognition of that, as indeed there was in Japan. I mean, the argument in Japan a year ago was that there wasn't enough sort of teeth in the TSE regulations, the Tokyo Stock Exchange regulations, and now investors are believing that to a greater degree, and that's one of the positive stories in Japan. In like manner, I think that Korea should be given some credit, maybe not full credit, but some credit, and the market trading at 1.1 times price to book, really doesn't seem to be pricing that, to any meaningful extent at all. Second thing is that the journey towards improving corporate governance didn't just start in February with the Value Up program. It started a couple years back with efforts to encourage MSCI to improve Korea's designation from emerging to developed market status. And there's concrete evidence, again, I won't go into the detail now, that shows that Korea has made tangible progress in that direction. So I think the idea that, none of that's priced in at all seems to us to be ungenerous. I think that's, you kind of get a free upside option on improving corporate governance in Korea at today's valuations.
Tim, do stay with us. Tim Moe from Goldman Sachs will be along with us to talk a little bit more about emerging markets in China in particular. That's up ahead on the Asia Trade. This is Bloomberg. Still with us is Tim Moe, who's a co-head of Asia Macro Research at Goldman Sachs. Tim, thanks for sticking around for us. I wanted to start off with, of course, the RBI decision that's in focus at the moment. They're still, in terms of taking a look at this chart, the expectations from the Reserve Bank of India after what has been a tumultuous week for growth expectations out of India. This is a picture as Bloomberg Economics really suggesting that, yes, the sort of focus on growth prospects will be sharpened. The market still sees a slim chance for a hike, but we could potentially watch out for more dovish comments from the RBI or even some sort of an adjustment of market expectations. BI already expecting cuts from the RBI. So I guess my question is, I believe that you're still relatively constructive on India. Has the turmoil of the last few days, has his weakened mandate with this coalition deal meaningfully changed the growth trajectory for India for you?
The quick answer is no. We still think that the underlying growth fundamentals are there. There are obviously going to be some ramifications in terms of the composition of the government's budget and likely expenditure given the political outcome. We wrote about that both from an economics and a strategy standpoint just 2 days ago in the wake of the election outcome. I think the key point now is that, as I said, I think the growth outlook is intact. And as you've seen from the recent economic numbers, they've actually come in above expectations. And our kind of 5-year central tendency view is that India can grow about 6.5% per year, which is obviously a very encouraging rate. And that's the core fundamental positive investment case for India, is that you've got a very strong economic growth backdrop. Corporate India's done a very good job of translating that into earnings growth. And that core earnings growth is what we think will drive the market, in the medium to longer run. Now, in terms of the impact of the election, I'd say the salient point here is that the composition of the budget, we think, will change somewhat. We still think there will be fiscal consolidation going from sort of mid-5s to 5.1% fiscal deficit, but there may be a greater focus on social spending and transfers, and that's something which may change some of the investment configuration in terms of leaders and laggards in the market. And the way we responded to that was by raising staples, which we've been previously underweight to market weight, in order to basically, as a hat tip towards the idea that there may be more direction of subsidies towards the low-income strata, and that may boost the demand for staples. So that would be sort of the way we're thinking about that chain of action.
I mean, it's been really interesting in terms of how much EM investors have been riding on political volatility, right? Not just India, but also Mexico, South Africa as well. Obviously, a different picture when it comes to the relationship between EMs and China. Do you expect much more momentum in this recovery if, for example, this is all we're getting from authorities and the PBOC in terms of economic support?
So a quick answer is that we do need more policy announcements, and we've also written about this, and our view is that we've obviously had a very strong move off the bottom, which was on January 22nd at very suppressed valuation levels, actually cycle low valuation levels of 7.9 times forward earnings. So you had kind of a coiled spring where you had the market down 62% from peak to trough. You had valuations compressing from 18 times to less than 8 times. You had very bearish sentiment and very low positioning. And then when you had those deltas, those changes in terms of property policy, and then also the 9 measures that was announced, which is supportive of the A-share market, then the market rebounded 32% from the low to the recent high. And then we've corrected about 6%, and we've kind of been range trading for the last couple of days. So the market's kind of worked off that overheatedness, kind of the steam to come out of that initial leg. Our view is that there could be another leg up, but that is contingent really on 2 things. One, an expected further delivery of policy. So all eyes are on the 3rd plenum in July and also the Politburo meeting at that time. And then also continuing delivery of corporate earnings. We definitely need earnings to come through. We've had some valuation recovery. We went from, as I said, less than 8 times to about 10.5. We're now at about 10, a little bit less as of last night's close. We think fair value is something like 10.5 to 11 times, so we can see a little bit more multiple recovery, but we need the earnings to come through to really validate that for investors. So I think the eyes are kind of back on the fundamentals, and the announcement by authorities to continue to support the property market and take out that so-called left-tailed risk from the market. That's kind of our composite view.
We're seeing tech earnings, at least in China, hold up relatively well, considering everything that's going on macroeconomically. Do you expect that to further fuel some gains in that tech sector inside China?
We do, Shery. And in fact, we've just published our single stock analysts have published on that overnight with a variety of results that came out. I'm not recommending anything on this show, but I'll note that Meituan came out with what our analysts has called a solid beat across all dimensions. So if you decompose, for example, first quarter numbers for China, in aggregate, they were kind of on the softer side, particularly for A shares. But the part that delivered the best earnings year on year was the ADRs, which obviously are where a greater portion of the tech sector is listed. So empirically, we're seeing better earnings delivery in that part of the market, and that indeed is an area that we continue to have a positive focus on.
How much risk when it comes to emerging markets in Asia do you see from a more resilient dollar?
Well, as you were mentioning earlier on that previous segment, I think that's one of the key risks that we're looking at. It's not a total, quote unquote, deal killer, but I do think that if the dollar is stronger for longer, that is a headwind. And I think that's particularly true in Japan, where you've got a very wide funding spread between where U.S. rates are, 525, 550 on the policy rate for the Fed, and just a touch above zero in terms of Japanese domestic rates. So that spread is not going to narrow by the BOJ raising significantly. There's limits to what can be done. So it's got to come down from the top. In other words, by the Fed cutting. And so I think that's why all eyes are on U.S. economic data and what kind of probabilities are there for the Fed to start cutting. I think that's going to be the key towards that cross rate. And that's something which is important not only for the Japanese market, but it's also important for Korea, for example, because the Korean won US dollar exchange rate is about 1370. That's very much at the high end of the range. Typically, it's an excellent entry point for the Korean market. Anytime you enter above 1250 to 1300 on a 12-month forward view, you almost invariably have made money. And in local terms, not even including some potential currency appreciation. So, we think it's a terrific entry point for Korea. But if the yen was to weaken further meaningfully above 160, say, that would put upward pressure on the KRW rate as well. So I think this could be a cascade effect if we have further weakness in the yen. So that is definitely an area that we're mindful of in terms of potential risks to the underlying constructive investment story.
Yeah, we'll be watching what the BOJ does and says next week as well. Tim Moe, good to see you again, co-head of Asia Macro Research at Goldman Sachs. We have more ahead on the Asia trade. This is Bloomberg.
Taking a look at some of the early movers, we're just about short of 25 minutes into the start of cash trading across these major markets. Samsung is in focus. Samsung Electronics upside of about 0.8%. We're hearing that Samsung's labour union saying that it plans to carry out its first ever strike, adding to some of these challenges for the largest company in South Korea. Of course, Samsung still looking to try and consolidate the recovery from setbacks across its semiconductor business, but we are seeing broad upside there in trading. SK Hynix, as well as some of the other chip-related names in focus. Hynix and TSMC have agreed to strengthen their cooperation on AI. We saw the SK Group chairman meeting with TSMC's new chairman on Thursday to agree to that deal in terms of cooperation in AI chips. Meetings were held sort of more broadly across the IT industry in Taiwan. We're also, of course, gauging for any reaction of this story on this antitrust probes in the US, Shery.
All right, Heidi, let's actually turn to those probes because regulators are set to be opening investigations into two of the world's most valuable companies, Microsoft and Nvidia. We understand the focus is on their dominance in the AI space. Our tech reporter, Belle Drulers, is in Hong Kong. Belle, so we've known that the BOJ and the FTC have been concerned for quite some time.
Yeah, that's right. They've been pretty public about this, these concerns that they had that perhaps big tech was just becoming a little bit too dominant in the AI space. But yes, the Justice Department, the Federal Trade Commission, both of these looking very closely at AI and really actually trying to come to terms and negotiate between the two agencies who would be looking after which company here. But the decision has been made. That's what we're hearing from our sources. The FTC is going to be looking after Microsoft. The DOJ is actually going to be looking at Nvidia and their dominance around AI chips in particular. But the concern here is really that these two players and just maybe perhaps a handful of others in the big tech space could end up really dominating AI in the way that we saw other big tech giants really take a very early lead in the initial days of the internet, mobile space. But the FTC in particular is going to be paying very close attention to deals that perhaps didn't follow traditional structures. And this chart here really putting that perhaps a little bit more into perspective, because there's just really three big drivers of those moves that we've seen in the S&P 500. That's Alphabet, but it's also Microsoft and Nvidia.
In terms of the details, what are they actually being investigated for?
So what we're hearing is that the FTC, which, as I said, they're the ones that are going to be looking after Microsoft. There's two deals that have really caught their attention, or two different partnerships. So firstly, there's OpenAI, and we know that Microsoft has poured billions to the tune of around $13 billion into that partnership. So there's concerns around that. But then there's also concerns around a deal that Microsoft did back in March, which is when they agreed to pay $650 million to license the AI software and hire much of the staff of Inflection AI. That deal as well didn't really follow traditional structures, definitely catching the attention of authorities.
And also catching the attention of authorities was a Bloomberg report on the Optica Foundation. What's the latest?
Yeah, so this was actually reported by Bloomberg about a month ago. So the Optica Foundation, it's a Washington-based foundation, and they fund a lot of research programs at universities across the US, and very high-profile ones, because Harvard is part of that. But essentially, we found out that Huawei had been funding one program to the tune of millions of dollars. Optica has now responded to that. They're saying that they're not going to be taking any further funds from Huawei. In fact, they're actually going to be returning all of that money to Huawei that are donated in 2024 and as well for the previous 2 years. But as we said, Huawei actually did promote those or provide those funds anonymously, and Optica, for its part, says this is actually something they've seen with other donors in the past, but still something that definitely did catch the eye of Congress.
Annabelle Jewelers there in Hong Kong. More ahead on the Asia trade. This is Bloomberg.
We're just about 30 minutes into the Asia trade, the top stories that you need to know. The ECB has delivered on its promise to cut interest rates with a quarter-point reduction, but leaving investors guessing on where policy had headed next. Officials say it will take longer for inflation to reach 2% and revised its CPI forecast for next year higher.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction.
Focus now turns to the US jobs report due out later on Friday. Bloomberg Economics expecting May's data to present contradictory views of the labour markets, with non-farm payrolls as well as unemployment rising together. And the US is said to be opening antitrust investigations into two of the world's most valuable companies, that's Microsoft and Nvidia, over their dominance of the rapidly emerging field of AI. Sources say the FTC and the Justice Department have agreed to divide the responsibility over those investigations. Shery.
Yeah, lots to digest in the tech sector as we continue to watch South Korea as well, playing a little bit of catch-up given that they're coming back from holidays. We had already seen Samsung Electronics really gaining ground throughout this week, given that optimism over cooperation with Nvidia. We're now hearing from SK that they're actually in cooperation with TSMC when it comes to AI chips. So the Kospi is now gaining 1%. We're seeing the ASX 200 also up 0.3%, a little bit muted when it comes to gains in the Japanese Chinese stock market. We are seeing households here in Japan boosting spending for the first time in 14 months, though, especially really a positive development given that we had seen wage gains by the most since 1994. So perhaps that's really filtering through the economy. The Japanese yen, though, really range bound ahead of the U.S. jobs numbers, Haidi.
And, of course, watching China trade data for May that's due out today. Let's bring our China correspondent Min Lo for a preview. So, Min, a lot sort of setting up when it comes to these expectations of what this recovery looks like. From last month, what are we looking at here?
Yeah, we're expecting exports to grow at a faster pace and for a second month as well. That's partly because of the low base last year. This time last year, if you remember, US and Europe were still dealing with growing high interest rates and inflation as well. And also we're in this global upturn, especially in the electronics sector. If you look at South Korea's trade data in May, exports grew 9%, and that's always a bellwether for trade in the region. Take a look at the forecast there on your screens. Imports growing at a slower pace, 4.3% compared to 8.4% in the previous months. That's partly a reflection of a weak domestic economy with a protracted property crisis and weak consumer sentiment as well. And so we see China leaning heavily on these export-driven growth. The Biden administration has just expanded its tariff regime on China. The good news is economists are saying that global demand can still provide a boost for China because those tariffed goods really represent a small sliver of Chinese exports to the U.S. But we want to watch very closely for the European decision on the outcome of that probe into Chinese EVs that could come anytime in the next couple of weeks. And that could make a more significant dent on Chinese exports because China sells about nearly 40% of its EVs to Europe.
And of course, when it comes to supporting the broader economy, we continue to watch central banks, right? It's really interesting that in China, we are seeing near zero inflation, yet the PBOC has been pretty reluctant to cut rates. What's going on?
Yeah, exactly. And the thing about this export-driven growth is that China's export is really dependent on the value of the yuan. And we saw how, with the yuan falling quite significantly in the last couple of years, that has eroded the strength in Chinese exports. And that's particularly significant in March when we saw this big decline in export value, which really masked the increase in export volume, which had edged up close to record highs. And so the PBOC has really had their hands tied. They can't really use monetary easing to boost the economy without risking the yuan falling too far below. And so now with the European Central Bank, the Bank of Canada already cutting rates, that kind of lowers the bar for the PBOC to act because not going first would kind of soften the impact on the value of the yuan. So we could expect the PBOC to cut their one-year rate as soon as in June.
The recent data has been pretty mixed. The outlook when it comes to whether these measures from the government to support the property market also remains mixed in terms of how successful they'll be. So what does that mean for the broader economic recovery?
Yeah, indeed, we're seeing this, different parts of the economy moving at different pace. And if you look at the PMI data as well in the last few weeks, the Caixin PMI had shown a modest uptick, but the official PMI data had shown a contraction. And in fact, the Caixin index had been outperforming the official index for 7 consecutive months now since October. And economists are attributing that to a stronger external demand, but a weak domestic demand. Because remember, Caixin measures the smaller export-oriented firms as opposed to the bigger state-owned enterprises. So if the trade data comes out strong, that would give officials some breathing room to tackle the other problems in the economy, especially the housing sector, the consumption trends as well. And we want to watch very closely for what happens in the July party plenum, because that's when there could be signals on what kind of reforms will be coming out, especially in the employment sector, because worries over income and employment, that's really a big factor that is preventing, holding back consumers from spending right now.
Bloomberg's China correspondent Ming Lo there with the latest on the broader Chinese economy. Let's stay in the country and turn to a tech giant. Alibaba.com has launched a cross-border trade service to help streamline the supply chain for smaller companies in the U.S. and beyond. Their president, Zhang, spoke to Bloomberg exclusively about the company's expansion plans and the impact of tariffs on the SMEs on its platforms.
So Alibaba.com, actually, we serve around 200,000 SMEs, suppliers, in China and also globally. And what we see this year compared with last year, I think several things. The first one is more and more SMEs is willing to participate in the global trade. So they are more willing to sell globally. So one example is that, so there's a small city in EU, all commodities actually selling and distributing in EU. And for the first quarter of this fiscal year, so customers in EU who join Alibaba.com actually grow 70% compared with last year.
Where are you really aiming to expand then Alibaba.com? Which markets are you going after?
So let's say from the buyer side and the supplier side. So from the supplier side, actually, we expand the supplies. So now it's not only in China, but it also expands globally as well, like in Southeast Asia, in Korea, in Europe, in Mexico, and North America. And last year, actually, we do acquisition in Europe called Visible, which is the biggest kind of marketplace in Europe. VOV for the Dutch language area and Europages for the rest of Europe. So now we are supporting them from the technology perspective to enable them to boost from the yellow pages to transactions to the kind of like the guarantee services that we provided to help the intra-business kind of trade. And Alibaba.com can help the global SMEs do the cross-border trade. So this is what we're going to expand. And for the buyer side, actually it's global buyers. The buyers, which is booming now, is in US, in Europe, and also in Latin America and Southeast Asia, this kind of developing countries. And different countries actually have the different type of demands for different categories.
The value proposition, I think, from a buyer is pretty clear. You can get perhaps a product for a cheaper price. What do you think then that there are concerns around overcapacity, for instance, from a lot of different European countries? How do you respond to those concerns? Because that sort of does speak quite closely to the Alibaba.com model of being able to connect more suppliers to new markets and offer good products for lower prices.
So in one way, that we are kind of enrich our selections with multiple supplies, like supplies in Europe. So we see there's a great supplies for fashion in France, like wines in Italy, and the machineries in Germany and in Italy as well. So there's a lot of SMEs actually doing a great job on Alibaba.com. And as well as we mentioned before, that we do acquisition, investment on Visible. We do that it's not only for a kind of financial investment. We are going to use our technology and the know-hows to kind of boost their technology engine to help the small and medium business within the Europe to do the kind of intra-Europe collaboration. So I think there's one part. The second part is the fundamental rule for global trade is supply and demand. So if there is demand required for kind of a quality product with a better price, and what we are going to provide is to lower the barrier for both sides. So the SMEs themselves, the entrepreneurs themselves, can survive and get enough margin out of that and can make a business.
Earlier this year, we did some reporting from the Canton Trade Fair, and some of the different people that we were speaking to there said that even with the risk of some very hefty tariffs, and that was referring to possible Trump tariffs if he were elected president again, but they would be able to withstand them given that the price is so competitive that's coming from China, and the quality as well is also so high that it still is a very competitive and compelling way or area or country to purchase from. What's your view on how much Chinese companies and the SMEs that are on the platform, how much can they withstand that risk of extra levies being applied to their products?
Okay. All the entrepreneurs, from their eyes, there are many problems that they need to solve. So what product I'm going to provide, what type of employees I'm going to hire, and what about the kind of, the economics, tax, and tariff is only one part of the tax. So when we see the global supply and demand, we're starting from the fundamental ones and how to improve the efficiency and how to help them to build up their own business based on the global supply chain, which is more competitive also for the SMEs. So that is what we do today.
Alibaba.com President Guo Zhang there, speaking exclusively to our tech reporter Annabelle Jewellers. More ahead on the Asia Trade. This is Bloomberg.
Take a look at how South Korean markets are trading at the moment, playing a little bit of catch-up after being away on holidays. The Kospi gaining more than 1%, really not doing much in terms of U.S. futures at the moment. But of course, what we're following right now is the tech sector. Given that we also heard that SK is in cooperation with TSMC in order to work on AI chips. And of course, we have that report on ongoing probes when it comes to Microsoft and Nvidia in the AI sector. But really, we had seen that incredible gain in South Korea's tech sector. And you can see SK Hynix gaining more than 5% at the moment. Let's stay with South Korea because we want to talk about artificial intelligence in the country, and there's one startup that's focusing on it, Wrtn Technologies. It's raised $18.3 million in a fresh funding round led by BRV Capital Management. It develops ChatGPT-like software offering services to Japanese and non-English speaking markets. It's partnered with Microsoft South Korea. Let's discuss their business plans and outlook. Joining us from Seoul is founder and CEO Tae-young Lee. Tae-young, great to have you with us. So first of all, I guess, tell us what you're planning to do with this new capital.
So thank you very much for having me today. And we just closed our pre-B round, and I don't know the exact exchange rate right now, but approximately we are $18 million, and we have a few more investors interested in us, so a few more millions could be added to that number. And actually, early this year we were going for a quick insider round, but we happened to meet with these guys who said they invested in PayPal, and it turns out they are BRV, the Blue Lawn Ventures, and we couldn't tell anyone, but we had long talks about their views of the market and whether it aligned with ours. So we decided to have a deal and become great partners, and we're gonna do this funding to more expand the country and
Yeah, so I know that you provide AI services to users for free, something that's actually appealed to many users, turning away perhaps even from ChatGPT. So tell us a little bit about your business model.
Okay, actually we are building a local Gen AI aggregator in Asia. So to understand what that means, we can look into the history. So in Korea, instead of Google and WhatsApp, we had local platforms such as Naver and Kakao that owns much of the market share in the region. And they started off as an iconic free services during the internet and mobile boom. And they acquired millions of users with free local services and really monetized by providing various other services like advertising or content. For example, they function as a mix of Google, News Service, Medium, and Quora, and all combined into one. So we take a similar approach. So think of us as a localized version of Perplexity and ChatGPT and Character AI combined. And it's another local aggregator facing up against tech giants. So I think what many people miss is that these businesses are extremely lucrative in Asia, and most of them in multi-billion-dollar range. And yes, that's what we are after, yeah.
Yeah, I want to ask about the lucrativeness of these businesses. What's your monetization plan? Shery mentioned, of course, these services are currently not being charging a fee.
Okay, then even when we start monetizing, we plan to keep the service free and by focusing on advertising and premium contents instead of charging users directly for usage. That way, the benefit of technology will be accessible to more people.
Your client demographics are interesting, right? Teens, people in their 20s make up almost 60% of the 3.7 million users. What does the demographics tell you about who's using this, for what purposes, and I guess how does that inform your growth strategy going forward?
Okay, so we are following a classic innovation adoption curve, and we start with early adopters last year, and now to break into early majority. So we are focusing on a specific segment, which is college student and adjacent segment like, teens and employees in their 20s. So which is working quite well. And our recent data shows that 70% of new joiners are below the age of 30, and we will establish ourselves firmly in this segment this year and continue to expand. Yeah.
Yeah, when you're talking about expanding, what sort of regions are you looking at, and perhaps languages? Because I really got to say, when I take a look at these translation services, it's actually quite frustrating that some of the local languages like Korean or Japanese don't really necessarily work out well.
Okay, well, we already have a global presence, and we just talked about how this is a thing in Asia. So accordingly, we already operate in Japan, and we plan to operate in other parts of Asia soon. So we've met various like Singaporean and Indonesian, Dubai, and Saudi officials to discuss potential rooms for collaboration and market expansion. So once we hit our growth target in Korea and Japan this year, we will start to operate in another country as well. So we are not a Korean-only company, and we are a global company focusing on certain regions. Yeah.
Seon Lee, founder and CEO at Wrtn Technologies. Really great to have you on with us. Let's take a look at some of the other tech stories that we're following this hour. And Meituan reported revenue for the first quarter at the beat of the average analyst estimate. It's also preparing for a potential entry into the Middle East and its first expansion beyond the China region. The founder, Guang Xing, says they're beginning to consider the feasibility of markets from Europe to Southeast Asia. Shares in Chinese EV maker NIO fell at a bigger-than-expected loss in the first quarter amid fierce competition in its home market. Its adjusted net loss widened to $677 million in the period. NIO's expansion in more profitable overseas markets is also facing headwinds, with tariff hikes in the US and another expected from the European Union. Boeing space taxi has docked with the International Space Station, bringing the spacecraft's first 2 passengers to the orbiting laboratory. The docking process had been delayed earlier due to a thruster malfunction. The docking was a key moment for the long-delayed Starliner spacecraft and an important test for Boeing. And SpaceX's Starship rocket blasted into space before plunging back into the Earth's atmosphere for an ocean landing, notching a key objective on its 4th major test flight. The vehicle landed in the Indian Ocean mostly intact. Elon Musk plans to use Starship to launch larger Starlink satellites and eventually bring cargo and people into space. More ahead on the Asia Trade. This is Bloomberg.
This is the Asia Trade. Here are the top geopolitical stories that we're tracking. Indian Prime Minister Narendra Modi says he looks forward to closer ties with Taiwan. Modi responded directly to Taiwanese President Lai Ching-te on social media. Lai had touted the fast-growing India-Taiwan partnership as he congratulated Modi on his 3rd straight election victory. This comes as Modi faces the renewed challenge of managing India's tense relationship with China. Israel is escalating its warnings against Hezbollah in Lebanon, threatening it could be forced into a war with the Iran-backed group. Prime Minister Benjamin Netanyahu visited a northern town in Israel where Hezbollah's rockets have caused significant damage. He vowed to restore security in the area one way or another. The U.S. said this week it's pursuing a peaceful solution between Lebanon and Israel to prevent a full-scale conflict.
Take a look at what we're watching, Shery, when it comes to commodities. Of course, a lot of this hesitation on what we could potentially see over the next few days, starting with the non-farm payrolls numbers, some repricing expectations from the Fed. Now, we know the story when it comes to oil. That broad downside has been sort of taking place on a weekly basis. We are seeing a little bit of upside for New York traded crude and Brent at the moment, but we are still set for really that weekly loss. It really is still OPEC Plus's supply plan. It's continuing to rattle the market to an extent when we saw OPEC Plus ministers kind of being forced to come out and say, yes, the group can still react to any changes and adjust supply if needed. We're also getting trade numbers out of China that are on watch as well. And to that end, we're seeing sort of iron ore, seeing a little bit of upside there. Broadly, metals are rebounding from that month low ahead of the US jobs data.
Yeah, and really given that we're still expecting those numbers, the expectation for the U.S. to having added 180,000 jobs in May and the unemployment rate to have held steady, we are really not seeing a lot of movement when it comes to setting up for the U.S. session. The futures not really doing much after the S&P 500 was also little change in the previous session, near all-time highs. The TAIEX futures a little bit of downside, while A50 China futures closed like this. That's it from the Asia Trade. The China Show is next. This is Bloomberg.